Hey, JJ here with the Art of Value. Thanks for joining me today. So today I want to talk about this interview slash conversation between Ray Dalio and Jeremy Grantham that happened on May the 9th. So around, let's say, a while ago, more than a month ago. May, June, it's only July. All right, so it was about uh, it was a 1 hour interview, and I'm going to summarize a little bit and comment on it a little bit. And there's a lot. I found it fascinating. There's a lot here to get through, and so it might be more than one part to this. So I want to keep this to 10 minutes, less than 10 minutes. So that's so I can upload it not only to YouTube and Spotify and the other podcast networks, but also to the likes of LinkedIn, Facebook, the Facebook page, and also TikTok. And did I say LinkedIn and Instagram as well? There's a lot, so because they take 10-minute videos now, those ones, so it's good. All right, so this is Ray Dalio and GMO's Jeremy Grantham on how they're seeing the world right now, recorded on the 9th of May, as I said. So who are they? If you don't know, they're the founders of Bridgewater and GMO, and they discuss the big risks that they're watching, including inflationary pressures, political conflict, asset bubbles, and climate change, and what investors can do to protect themselves. So big and heavy stuff here, and Jeremy Grantham, as you know, has been pretty bearish. He thinks it's a big bubble, and Ray Dalio thinks similar. They've known each other for like 25 years. And so let's get on with it. What they say is, the first question is, have they learned a lot? First of all, they've learned a lot from each other over the decades, they say. They're both students of history, thinking deeply about lessons they can learn from the past. And the first question was about the current environment. Is it similar or different to anything that they've seen in the past? And Ray said the lessons he learnt over the time have been important, like in 1971 and then repeatedly. So what he's learned is surprises happen. And he gave the example of then when Nixon severed the relationship between gold and the dollar, essentially defaulting, that day he thought the market was going down a lot, and it went up. So he was surprised by that. You can never predict what the market's going to do in the short term. So he says three big things happening in his lifetime. So he talks about the plan. He's talked about this before. He's written a long book. He talks about this quite a lot, so it's not a secret. But this is kind of summarizing what he thinks. Is there three big things happening in his lifetime, and with a bit of research, he found five things. So he talks about the main points: the amount of internal political, economic, social conflict that's going on right now, and the rise of a great power to challenge existing world order. You might have seen that in one of his videos, and he means China and the geopolitical stuff that's going on right now. So the US is becoming less dominant, and he says he's done some research over the past 500 years, which is in his book, and rise and decline of currencies and their empires was a big theme that he found. And the acts of nature had had bigger effects than you would think, even with the wars, even with wars, not counting wars. So he says droughts, floods, pandemics, and he says climate change will be a factor. He knows that Jeremy is pretty big on that, so he agrees there. And humans' capacity to adapt to invent, though, and the big cycles and events are dominant, even though we can adapt. So the question was, how are the categories playing out right now? And he says there's a supply and demand debt and credit that is having an effect of moving into a stagflation environment, and the political influence is the most important at the moment, and which has changed from economics. Economics have ruled, but now the ideological rules, like in terms of the allocation of resources, etc. And he gave an example of it, like Elon buying Twitter. It was like an ideological thing situation and political rather than purely economic, about free speech and so forth. And so then when it comes to Jeremy, he said he thinks there are much more important things than the stock market right now, and he said Ray would agree with that. Going on, one thing I've kept going in resources and climate change investing. So in terms of his investing, he's pretty old now, but he still keeps talking about the market. And he's a student of bubbles. For old time's sake, he researches investment bubbles. Over the time, he's researched a lot. This is unexpectedly the third great investment bubble of my career, he says, out of the last 40 or 50 years. It's been the worst year opening for the year in the market since 1939. Remember, this was at the beginning of May, so it's got worse since then. Nasdaq and Russell 2000s are in bear markets, and the S&P 500 wasn't quite then, but it has been since. It's getting to be interesting, he says, and Bitcoin down too, with ARK back to 2018 levels, below this entire bubble event. And he mentioned the meme stocks, AMC, and others down 75% from their peak, and other meme stocks down. Said it's the real McCoy, the real bubble, playing out pretty close to the 2000, like the 2000 bust. And he considered himself a serious amateur historian of bubbles and markets. And the focus has been on the four great bubbles, characterized by severe weird over-optimism, which is actually really rare in markets, he says. And so it's been characterized by an accelerated move to the upside and a weird deviation on the upside of the blue chips going up and the risky stocks going down. So that's just happened in a few bubbles, only a few, in a rare. He said it's like hen's teeth when that happens, and it happened in 1929, it happened in 2000, and it happened last year, where the S&P kept going up through September 2000, growth going down 50% in that time. The internet. That in 2000 growth went up 50%. Let me start that again. The S&P kept going up through to September 2000, even though the bubble started popping in March, and the growth going down 50% in that time. Internet going down 60 or 70% by then, and it was spectacular. And he said we saw a handsome deviation last year between the S&P 500 rising and the Russell 2000 dropping. So there was this 25 point spread on the upside. That for me was a pretty good indicator. It describes I've got to keep dancing because the music is still playing, and haven't heard him describe this before, but he said that the financial sector is playing up to and over the edge, dancing over the edge. What causes the indicator above is transferring from riskier stocks to like the Coca-Colas, the blue chips, and in that case, dancing right to the edge. And that's exactly what happened. We saw this last year, he said, and by this year, it was clear it was the real McCoy of a bubble. He said he wrote a piece, which I read. I've read both of these articles he's about to say. He said, I wrote this piece a year ago, waiting for the last dance, and this January let the wild rumpus begin. So he's waiting for it as the riskier stocks started to collapse, and then then this year it was actually happening with the bigger companies, which it did. It started in November. We're in it now, and it's unwinding, he says. I believe the declines will be very substantial. And Ray says, the question was, how are the trends you and Jeremy been describing in the last, how will they play out in the next 5 to 10 years? And I'll leave that because we're coming up to the 10 minutes, and I found that fascinating what Jeremy Grantham has sort of said about bubbles, and I've done a number of podcasts about what he's predicted, and it's sort of playing out, even though people say it's a broken clock, the usual things. But he seems to have got this one right, how it's unfolding this time. Anyway, so if you found any value in this and you want to hear the next one, part 2 I'll do, like and subscribe on YouTube, Spotify, all those other places I mentioned at the beginning, and on Twitter, of course, at The Art of Value. Join me there, and we'll talk more about this next time. Okay, thanks. See you next time.